Picture this. The grill's going in the backyard, friends, family, they're all there, and you're holding at that final piece of paper for maybe the biggest debt you'll ever have, and you light it up. The mortgage burning party.
Ah, yes, that dream.
That dream, right. Being totally free from that huge monthly payment, the peace of mind, owning your home free and clear. It feels like the ultimate financial goal for so many people, doesn't it?
It really does. You know, for a lot of folks, paying off the mortgage goes way beyond just the numbers. It's tied up with feelings of security, independence, hitting a massive life milestone. It's a really powerful feeling.
And that powerful dream.
Yeah.
That's exactly what we're digging into today. Paying off your U.S. mortgage early. We've gathered a whole stack of material here. Insights from big financial names like U.S. Bank and Bankrate, practical advice from people like Ramsey Solutions and Nationwide.
We've also got some deeper analysis from Knowledge at Wharton, stuff from Forbes, incharge.org.
And even a look at a real online chat where people were hashing this out. Real-world perspectives.
Yeah, and our mission here, really just based on what all these sources are telling us, is to cut through maybe the emotion, the conflicting advice you sometimes hear.
Right.
We want to unpack the actual ways you can pay it off faster, look at the real benefits, the why behind that dream, but critically, also explore the potential downsides, the things you might not have considered.
So the goal is to give you, the listener, clarity based on all this information to figure out what might be the smartest path for your situation.
Exactly.
Okay, let's jump right in then. When you talk about paying off your mortgage early, what does that actually look like in practice? It's probably not finding a giant pile of cash under the mattress for most people.
Probably not. That's a good starting point. I mean, U.S. Bank does mention, paying the whole thing off in one go if you happen to have the money.
Right, like an inheritance or something.
Yeah. But the much more common strategies, the ones our sources really focus on, involve consistently making extra payments, specifically towards the principal balance, chipping away at it over time.
Systematically attacking the debt.
That's it.
And the sources lay out specific methods for doing this. One that pops up a lot is switching to bi-weekly payments.
Yes. Bankrate explains this one really clearly. The basic idea is surprisingly simple. Instead of one full payment a month, you arrange to pay half your monthly payment every 2 weeks.
Okay, half a payment every 2 weeks. How does that actually speed things up?
It's all about the calendar, really. 52 weeks in a year. So if you pay half your payment every 2 weeks, that's 26 half payments over the year.
Okay, 26 halves.
And 26 half payments equals 13 full monthly payments. See? You effectively sneak in one extra full payment each year. And you do it without really feeling a huge pinch in any single pay period because it's spread out.
So it's that extra 13th payment that chips away at the principal faster. But the sources seem really insistent that this only works if the lender handles it correctly.
Oh, absolutely vital. Bankrate and Nationwide both really hammer this point home. You have to confirm with your lender or your loan servicer, whoever handles your payments, that those extra bits are going directly to the principal balance, not just sitting in escrow or being applied to your next month's payment or something else.
Because if it doesn't hit the principal right away,
you lose the whole point. You don't get the accelerated payoff. You don't get the interest savings. It's a simple check, but it's crucial.
Let's put some numbers on it with that Bankrate example. Say your normal monthly payment is $2,095.
Okay.
A biweekly payment would be half that, so $9,047.50. You pay that every 2 weeks. So over a year, that's $1,047.50 times 26, which comes out to $27,235.
Right.
Compare that to your standard 12 payments. That's 12 times $2,095, which is $25,140.
And differences.
Exactly $2,095. One extra monthly payment, just spread out.
And that one extra payment, year in, year out, it has a massive impact over the long haul of a mortgage. Bankrate shows this with a hypothetical loan. $350,000, 30-year term, say 7% interest rate.
Okay. Pretty typical scenario for some folks right now.
Right. And just by making those biweekly payments and making sure the extra goes to principal, you could save over $112,000 in interest.
Wow, $112,000.
And you could cut 7 years off the loan, pay it off in 23 years instead of 30.
7 fewer years of payments.
Yeah.
Just by changing when you pay half. That's incredible.
It really is. That example really drives home the power of consistency. Even small, steady, extra payments add up hugely over time, mostly because you're knocking down that principal balance faster.
You're leveraging compounding for you instead of against you.
Exactly. You shrink the base that interest is calculated on, especially in those early years when interest makes up most of the payment.
Okay, so biweekly is one structured approach. But the sources also talk about just making extra payments more generally, right?
Yeah.
Not necessarily on a fixed schedule.
Yeah, Ramsey Solutions and Nationwide cover this too. It doesn't have to be some formal bi-weekly program linked to your paycheck. It's simply about intentionally sending more than your minimum payment whenever you can swing it.
And again, the key instruction is
Same thing. Make absolutely sure that extra money is earmarked for the principal balance.
don't just send extra cash and hope.
Definitely not. Nationwide stresses this. You need to be clear with your lender. Often there's a specific box on the payment slip or an option online to designate extra funds to principal. Specify where it goes.
And the sources had some interesting ideas for how people find this extra money.
Yeah, Nationwide had some practical tips, like just rounding up your payment. Bill is $743. Pay $800. That extra $57 hitting the principal month after month adds up.
Or sort of like a biweekly idea, but monthly. You could aim for that 13th payment by taking your regular monthly payment, dividing it by 12, and adding that little bit extra to each of your 12 payments. So if your payments, say, $1,500, you divide by 12, that's $125. Add $125 extra each month, and by year end, boom, you paid an extra $1,500.
That's a really systematic way to do it without the formal biweekly setup. Bankrate and Nationwide also mention using windfalls.
Like a bonus or a tax refund.
Yeah, exactly. Money you weren't necessarily counting on for regular expenses, maybe even credit card rewards or cash back. Just taking that unexpected cash and throwing it straight at the mortgage principal, it can feel less painful and really accelerates things.
Nationwide also had this interesting little psychological trick. The $1 a month plan.
Yeah, I like that one too. It's about building the habit slowly. You just increase your payment by $1 single each month.
So month 1, it's your normal payment. Month 2, normal plus $1. Month 3, normal plus $2.
Right. And they used an example, a $150,000 loan at 6% over 30 years. Just adding that extra dollar each month could potentially shave 8 years off the loan term.
8 years, just from adding $1 more each month.
It shows how consistency, even tiny amounts, really compounds over decades.
And those Ramsey Solutions examples really hit home the impact of more substantial extra payments. They had one with a $200,000 remaining balance. Didn't specify the rate, but the point stands. Adding an extra $300 a month could save over $64,000 in interest and pay it off 11 years sooner.
11 years faster. That's significant life impact right there.
And if you could manage even more, their other example, $350,000 balance, adding $1,000 extra a month.
Let me guess, even bigger savings.
Almost $156,000 saved in interest and paid off nearly 16 years faster.
Wow. Okay, the numbers are definitely compelling.
It really makes you ask, why do these extra payments, especially early on, make such a massive difference? Nationwide and Forbes kind of get into the mechanics of this, the amortization schedule.
Yeah, understanding amortization is key here. In the first several years of a typical 30-year mortgage, most of your payment, the vast majority, is just covering the interest that built up since your last payment.
Right, only a tiny sliver actually reduces the loan amount initially.
Exactly. Only a small piece goes to principal. Over time, that ratio slowly shifts. Towards the end of the loan, most of your payment is principal, very little is interest.
So making extra principal payments early
is like hitting the debt where it's strongest. You reduce that huge principal balance faster, right at the beginning. And since all future interest is calculated on the remaining principal,
lowering that balance sooner means less interest accrues over the entire rest of the loan.
Precisely. You're cutting the interest off at the knees, essentially. It's front-loading the debt reduction for the biggest long-term savings.
Got it. So you're attacking the source of the interest right away.
That's the power move.
Okay, so beyond these extra payment strategies, the sources mentioned a couple other ways people accelerate payoff. U.S. Bank noted, obviously, paying the whole thing off in one go if you suddenly get a large sum of money.
Right. The windfall scenario, again, inheritance, selling a business, whatever it might be, that's the quickest way, assuming you've weighed the pros and cons we'll get to.
And another structural approach mentioned by U.S. Bank and Nationwide is refinancing.
Yes, refinancing specifically to a shorter loan term, like going from a 30-year mortgage to a 15-year.
That forces a faster payoff, just by definition, right? Higher payments.
Exactly. Your required monthly payments will be higher, naturally paying it off much faster. And often, when you refinance to a shorter term, like 15 years, you might also qualify for a lower interest rate than you had on the 30-year.
Oh, interesting. So double benefit, potentially.
Yeah, you pay less interest per dollar, and you pay the dollars off faster. Big savings potential there.
Though refinancing isn't free, of course. There are closing costs, and you're committing to that higher payment immediately.
Absolutely. It's a different kind of commitment compared to just adding extra payments when you feel you can. It's locking yourself into that higher payment structure.
Okay, so we've got the methods down: bi-weekly, extra payments, lump sums, refinancing. Now let's really dig into the why. What are the big pros? Why do people want this mortgage freedom so badly?
Well, the number one reason, cited again and again in sources like US Bank and incharge.org, it's not strictly financial, it's peace of mind.
Just knowing it's gone.
Yeah. Carrying that huge debt, often the biggest debt you'll ever have, it can weigh on you, it can be stressful. Getting rid of it brings this huge sense of security, especially, they note, for people getting closer to retirement, maybe facing lower or less predictable income.
Incharge.org called paying it off a sure thing return. Unlike investing, where there's uncertainty, that must contribute to the feeling of safety.
That certainty is incredibly valuable to many people. Just knowing your home is truly yours, no strings attached, no big payment looming, that psychological comfort is hard to put a price tag on.
Then there's the obvious financial win: saving on interest.
Oh yeah, this is the big quantifiable benefit. Almost all our sources stress this: Bankrate, US Bank, Ramsey, Nationwide. By cutting the loan term short, you avoid paying potentially massive amounts of interest over the years.
Like that Bankrate example, over $112,000 saved just with biweekly payments.
Exactly. And the higher your interest rate is, the more powerful this effect becomes. Every extra dollar you pay towards principal is directly saving you future interest payments at that rate. It's a clear return on your money.
And that adds up, potentially freeing up tens, even hundreds of thousands of dollars over what would have been the full loan term. Money that stays in your pocket, not the bank's.
That's right. Money saved is money earned, essentially.
Another pro mentioned is building equity faster.
Yeah, Bankrate, US Bank, Ramsey Solutions all explain this. Every extra bit you pay towards principal directly increases your ownership stake in your home. Your home equity, that's just the home's value minus what you owe.
So paying down the debt faster means your equity grows faster.
Right. And having more equity can be useful down the line.
How so?
Well, Bankrate and US Bank point out that higher equity might give you easier access to lower cost borrowing options later if you need funds. Things like a home equity loan or a HELOC, a home equity line of credit.
Borrowing against the value you've built up.
Exactly. You've basically created a pool of value in your home you could potentially tap into, usually at better rates than, say, a personal loan or credit cards, though that's taking on debt again, of course.
And if you end up selling the house, Bankrate mentions you keep more of the profit.
Makes sense. Less debt to pay off at closing means more of the sale price comes directly to you after costs.
And the final big pro: once that mortgage is finally history, that big monthly payment disappears.
Yes. US Bank and incharge.org highlight this. All that cash flow that was going to the mortgage payment every month is suddenly freed up.
What do people do with it?
Well, now you can pour it into retirement savings, invest more, save for college, travel, whatever your other goals are. Incharge.org specifically says you can start saving at an accelerated rate once the mortgage is gone. It gives you huge flexibility.
Okay, so peace of mind, huge interest savings, building equity faster, keeping more when you sell, freeing up cash flow later. Those are really compelling reasons. But is it always the smartest financial move?
Now we get to the crux of it. This is where things get more complicated and where the sources bring up some really important potential downsides or, let's say, considerations.
Because it feels so good, it must always be right.
Not necessarily from a purely optimal financial standpoint. And the biggest counter-argument, the one that fuels most of the debate, especially in that Reddit thread and the analyses from Forbes and Wharton, is opportunity cost.
Right. The idea that your money could be doing something else. If it's paying down the mortgage, it can't be invested somewhere else that might earn more.
Precisely. Every extra dollar you send to the mortgage company is a dollar you didn't put in the stock market, or into a high-yield savings account, or maybe towards starting a side business.
That Reddit discussion really captured this dilemma, didn't it? The person asking had, what, a 6.25% mortgage rate?
Yeah, and they were wrestling with, Pay down the 6.25% debt aggressively, or take that same money and invest it, hoping to earn more than 6.25% in the market over the long term.
That really boils down the core question, doesn't it?
It does. Is the guaranteed return you get from paying off your mortgage early, which is equal to your interest rate? And remember, saving interest is effectively tax-free.
Right. You don't pay tax on money you don't spend on interest.
Exactly. Is that guaranteed tax-free return better or worse than the potential, but definitely not guaranteed, return you might get from investing that money elsewhere?
And the answer seems to depend heavily on the numbers involved. Your specific mortgage rate versus potential investment returns.
Absolutely. U.S. Bank, Forbes, the Reddit discussion, they all make this point. If your mortgage rate is high, say 7% or 8%, getting a guaranteed, risk-free 7-8% return by paying it down looks pretty good. It's tough to consistently beat that investing without taking on real risk.
But if your rate is super low, like from the refi boom a few years ago, maybe 3%.
Then the calculation shifts. Suddenly, the historical average returns of the stock market, even if you're conservative about future expectations, might look a lot more appealing than just saving 3% interest. The potential upside from investing could be much higher.
Knowledge at Wharton did a specific analysis on this, right, with a low-rate example.
They did. A hypothetical $500,000 loan, but with a low 3.0% interest rate. They compared putting an extra $210 a month towards the mortgage versus investing that same $210 in the stock market over the 30 years.
And what did they find? Assuming reasonable market returns.
Using historical data, but even toning down future expectations to a modest 5.5% average return, they found that investing that extra $210 a month could potentially leave you with significantly more money after 30 years, something like $57,000 more compared to using it for extra mortgage payments.
$57,000 more by investing instead of prepaying a 3% mortgage. That's substantial.
It is. And they highlighted something interesting, too, the asymmetry of the outcome.
Yeah.
Their analysis suggested that while, yes, investing could sometimes underperform the guaranteed 3% return from paying the mortgage, the losses in those scenarios tended to be smaller than the gains in the scenarios where investing did better.
So the potential upside from investing was often bigger than the potential downside compared to just paying off the low-rate loan.
That's what their historical modeling suggested. It implies that over the long run, the odds might favor investing when your mortgage rate is very low. But again, they stressed, past performance isn't a guarantee, and your own comfort with risk is huge.
Okay, so opportunity cost is massive.
Yeah.
What else? Liquidity comes up a lot.
Hugely important. U.S. Bank, bank rate, the Reddit chat, they all flag this. Money you sink into paying down your mortgage principal becomes home equity. And home equity is not cash in hand.
It's tied up in the house.
Right. It's not easily accessible if you suddenly need money for an emergency, like a job loss or a big medical bill.
And U.S. Bank and Forbes were really clear about what needs to come before aggressively paying down the mortgage.
Absolutely. They strongly advise having a fully funded emergency fund first before you even think about sending extra to the mortgage company.
How much is fully funded?
Generally, enough readily available cash, like in a savings account, to cover 3 to 6 months of your essential living expenses.
Why is that so critical?
Because you don't want to be house rich and cash poor. Imagine paying down your mortgage super fast, then losing your job. You might have lots of equity, but you can't easily pay the bills with it. You might end up taking on high-interest credit card debt or trying to tap your home equity with a HELA OC.
And ELOCs aren't always reliable emergency funds.
That's a key point they make. HELA OCs are loans you have to repay with interest. And crucially, lenders can sometimes reduce your available credit line or even freeze it entirely, especially during tough economic times, exactly when you might need the cash most. So don't count on a ELOC as your primary emergency plan.
So the mantra is emergency fund first, build that safety net, then worry about the mortgage.
Financial stability needs that foundation. Liquidity matters.
Okay. What about other savings goals? Could focusing too much on the mortgage hurt those?
Yes, that's another potential conflict. Forbes, in particular, has a kind of hierarchy of where your money should go before you accelerate mortgage payments.
Like what?
First, are you contributing enough to your 401k or similar workplace retirement plan to get the full employer match?
Because that matches.
Free money. Often it's a 50% or 100% return on your contribution, instantly, guaranteed. It is incredibly hard to beat that return by paying down a mortgage, especially a lower rate one. Missing the match is leaving money on the table.
Okay, so 401k match first. What else?
Paying off high-interest debt. Think credit cards. If you're carrying balances at 18%, 22%, paying those off gives you a guaranteed return of 18% or 22%. That almost certainly beats paying down a mortgage at, say, 6%.
Makes sense. Attack the most expensive debt first.
Right. Even some student loans, if the rates are high and maybe not deductible, might come before the mortgage.
Forbes also mentioned HSAs, health savings accounts.
Yes. If you have a high deductible health plan and are eligible for an HSA, these are often seen as triple tax advantaged. Money goes in pre-tax, can grow tax-free, and comes out tax-free for qualified medical costs. For many, maximizing HSA contributions is a very powerful financial move that could take priority over extra mortgage payments.
So there's a clear pecking order suggested by sources like Forbes and U.S. Bank.
Pretty much. Emergency fund, kill high-interest debt, grab that 401k match, consider HSA maxing, then think about accelerating the mortgage payoff.
Got it. Now, let's tackle the tax deduction thing. People love their mortgage interest deduction. Losing it feels like the downside of paying off early, but the sources suggest maybe it's not as big a deal as we think.
That's a really important point, and Forbes and Knowledge at Wharton break it down well. Yes, mortgage interest can be deductible. There are limits. Currently, interest on up to $750,000 of mortgage debt is deductible, or $1 million for older loans.
But the actual benefit might be small for many.
Exactly, for a few key reasons. First, remember amortization. The interest portion of your payment shrinks over time, so the potential deduction gets smaller each year anyway.
Okay.
Second, and this is the big one for many people now, you only get any benefit from the mortgage interest deduction if you itemize your deductions on your tax return.
Instead of taking the standard deduction.
Right. And you only itemize if your total itemized deductions, mortgage interest, plus state and local taxes capped at $10K, plus charitable donations, etc., add up to more than the standard deduction amount.
And the standard deduction is much higher now than it used to be.
Much higher, which means far fewer people itemize now. If you take the standard deduction, your mortgage interest gives you zero tax benefit. Absolutely none.
Wow. Okay. And even if you do itemize?
Even then, Forbes points out, the benefit is only on the amount above the standard deduction.
Right.
If the standard deduction is, say, $28,000 for a couple, and your itemized deductions total $28,500, you're only reducing your taxable income by $500, even if you paid $15,000 in mortgage interest that year.
So the deduction itself might not be saving you much tax, even if you technically qualify.
Exactly. And Forbes makes the killer point. You are always paying way more in interest than you could ever save in taxes from deducting it.
Explain that.
Okay, say you pay $10,000 in interest in a year, if you're in the 22% federal tax bracket and you itemize, and that deduction actually lowers your taxable income. At most, it saves you $2,200 in federal taxes. You paid $10,000 to save $2,200.
You're spending dollars to save dimes, basically.
Or quarters, maybe. But you're still spending way more than you save. Paying off the mortgage eliminates the entire $10,000 interest cost. While U.S. Bank acknowledges losing the deduction could raise your taxable income slightly if you were itemizing, the net financial gain from stopping the huge interest payments usually swamps that effect.
So the takeaway is, don't let the tax deduction tail wag the financial dog. It's probably not a major reason to keep the mortgage around.
That seems to be the consensus from the sources. Focus on the actual interest costs versus other uses for your money.
Okay. Any other potential, maybe smaller downsides mentioned? Prepayment penalties.
Yeah, bank rate. U.S. Bank, Ramsey mentioned this. It's apparently not very common on standard mortgages these days, but some loans might have a penalty if you pay off a large chunk or the whole thing early, especially in the first few years. So rule number 1, check your loan documents or call your lender to make sure.
Good advice. What about credit scores? Does paying off your biggest loan hurt your score?
U.S. Bank says it can have a small, usually temporary, negative impact. Paying off a loan closes the account, which can slightly reduce the average age of your accounts and change your credit mix, the types of debt you have.
But probably not a huge deal for most.
Usually not, especially if you have other credit lines in good standing. And they note the peace of mind often outweighs any minor temporary dip in the score for most people focused on becoming debt-free.
And we mentioned needing to be proactive about setting up extra payments correctly.
Right. Bankrate and U.S. Bank emphasize you can't just passively send extra money. You need to contact your lender, figure out their specific process for applying it to principal, maybe adjust auto pay. And definitely avoid those third-party payment services, Bankrate warns. They often charge fees for something you can do yourself for free directly with your lender.
Okay. One last potential negative that came up in that Reddit thread. Missing out if rates drop later.
Yeah, that's an interesting opportunity cost angle. If you work hard to pay off a 6% fixed-rate mortgage, and then 2 years later rates plummet to 3%, well, you missed the chance to refinance the remaining balance down to that super low rate.
You locked in your 6% return by paying it off, but you can't benefit from the lower market rates later without taking out a whole new loan.
Exactly. So paying off early is kind of a bet that rates won't fall dramatically below your current rate in the foreseeable future. It's part of the calculation.
Okay, wow. Methods, pros, cons, considerations. Let's just circle back for a second to really focus on that core conflict. Invest versus payoff. Because the sources make it clear this is the heart of the financial debate for most people.
It absolutely is. And the arguments on both sides, pulling from Forbes, Wharton, Reddit, really highlight the different ways people weigh the factors.
So the arguments for paying off the mortgage early often boil down to guaranteed return and no risk.
Pretty much. Like we heard from Reddit and Forbes, paying down your mortgage gives you a guaranteed return equal to your interest rate. A 6% rate means a guaranteed 6% saving on that principal. And it's effectively after tax. Very appealing, especially if your rate is higher.
And it's totally risk-free, right? Incharge.org and Reddit stressed that. No stock market crashes wiping out your principal. Certainty.
And that certainty feeds directly into that huge psychological benefit, the peace of mind, which, as US Bank and Incharge.org point out, is invaluable for some people. They might consciously choose that feeling over potentially higher but riskier financial returns.
Okay, then the arguments for investing the extra money instead.
The big one there from Wharton, Forbes, the Reddit debate, is the potential for higher returns over the long haul. Historically, the stock market's average annual returns have often been higher than mortgage rates.
So if your mortgage is 4%, and the market historically averages, say, 9%, investing could grow your wealth much faster.
Potentially, yes. Although everyone stresses, past performance doesn't guarantee future results. Investing absolutely involves risk.
But Wharton's point about the asymmetry.
Right, that was interesting. Their model suggested that while investing might sometimes do worse than the guaranteed mortgage payoff return, the potential gains when it does well have historically been much larger than the potential losses when it underperforms, relative to that mortgage rate. The upside could be bigger than the downside risk, historically speaking.
Plus, investments are usually more liquid than home equity, as Reddit and Wharton noted. Easier to access the cash.
Generally, yes. Selling stocks is usually quicker and easier than getting cash out of your house equity.
And the minor point about keeping the tax deduction, though we've kind of debunked that as a major driver.
Yeah, probably shouldn't be the main factor.
So, navigating this, how do you actually decide? What do the sources say guides the personal decision?
The message is really consistent across the board, from US Bank to Forbes to Incharge.org. There is no single right answer that fits everyone.
It's personal.
Deeply personal. It comes down to you weighing the hard numbers, your interest rate versus potential investment returns against your personal feelings. How much do you value that debt-free peace of mind versus the potential for more wealth but with more risk? Incharge.org and US Bank frame it exactly as that balance.
And the key factors to weigh are:
your specific mortgage rate higher rates make paying off more attractive. Your tolerance for risk lower tolerance favors paying off. Your overall financial health emergency fund, high interest debt, retirement saving status need to be solid first. How long you plan to be in the home matters too. And your age, your investment timeline, younger folks might lean more towards investing.
And US Bank and Forbes were really emphatic. Get the financial foundations right first. Emergency fund, high-interest debt, 401k match. Don't skip those steps to rush the mortgage payoff.
Absolutely. Those are often higher priority moves for overall financial health.
What about doing both? Did anyone suggest that?
Yeah. The Reddit thread mentioned a hybrid approach.
Yes.
Splitting extra money, some towards the mortgage principal, some towards investments. That could give you a bit of both worlds. Some guaranteed return and debt reduction, plus some potential market growth. A middle path.
And finally, maybe talk to someone.
Definitely. US Bank strongly recommends getting professional financial advice. Given how complex and personal this is, a qualified advisor can look at your whole picture, income, debts, goals, risk tolerance, and help you tailor a plan that makes sense for you.
Okay, let's try and wrap this deep dive up then. If we boil down everything from this stack of sources on paying off your US mortgage early, what are the absolute must-know takeaways?
Well, the sources consistently show it offers that really appealing mix. Guaranteed savings on interest, which can be huge, plus that powerful peace of mind. But it's not free. It costs you liquidity access to your cash, and you give up the potential for higher returns you might have gotten by investing that money instead.
And that mortgage interest tax deduction. Probably not as big a factor as many think.
Right. For most people, the interest cost itself is way more significant than any tax savings from the deduction.
And crucially, the right decision is completely personal, no magic formula.
Exactly. It depends entirely on your numbers, especially your interest rate, your comfort level with risk, whether you've got your financial basics covered like an emergency fund and no high-interest debt, and what your bigger life goals are. Prioritizing those basics usually comes first.
So it's a balancing act. The certainty and feeling of eliminating debt versus the potential but uncertain path of using that money to maybe build more wealth through investing.
That's the core trade-off. Certainty versus potential, security versus growth, math versus emotion.
Which leaves us with a final thought, something for you, the listener, to really chew on based on all this. If paying off your mortgage gives you a guaranteed return equal to your interest rate, and if history suggests investments might offer higher returns long-term, albeit with risk, does real financial freedom come only from being debt-free? Or could it also come from strategically managing debt, like a low-rate mortgage, to potentially build even greater wealth over time?
It's a deep question, isn't it? How do we define financial freedom for ourselves? Definitely something to think about as you look at your own situation and decide what path feels truly right for you.
So take a close look at your own numbers. Maybe play with some online calculators like the ones mentioned in the sources to compare scenarios, and seriously consider talking it through with a professional advisor. That's been our deep dive into paying off your U.S. mortgage early.
We really hope unpacking all these different perspectives helps you navigate the pros, the cons, and all the complexities involved in making this big decision.